Hello, and thank you for joining us for Market Sense. I'm Jim Armstrong with Fidelity, filling in this week for Heather. Peace talks in Iran have stalled, but that doesn't seem to be doing much to stop markets from reaching new highs. We have renewed optimism about artificial intelligence, particularly in the chip sector, and that has been fueling record rallies both on the S&P 500 and the Nasdaq. Plenty more on deck to talk about in the coming days as investors look to several mega cap tech stocks to do their corporate reporting. And the Federal Reserve is also meeting this week to talk about the future of interest rates. So no shortage of things to talk about. And to have today's discussion, we are thrilled to be joined by Fidelity's Director of Global Macro, Jurrien Timmer. And we are also thrilled to be joined by Fidelity's Director of Quantitative Market Strategy, Denise Chisholm. Part of the work that Denise does is take a look at historical trends, looking for insights that she can then apply to what's happening today. And part of what we'll be talking about in just a few minutes involves Denise's insights on some of the recent pullbacks this year in various sectors and the potential opportunities those pullbacks might present for investors today. Denise, Jurrien, thank you so much for taking time out of your day to be with us.
Hey, it's great to be back, Jim.
Great to see you, Jim. Welcome back, Denise.
We're going to start with the headlines. Today is, of course, Tuesday, April the 28th. And as I mentioned a moment ago, the Federal Reserve is, in fact, meeting this week to talk about interest rates. General consensus seems to be that with oil prices accelerating inflation, a rate cut is probably not expected. However, Jurrien, I want to get your take on what probably could come out of this FOMC meeting. And that's news mostly about Jerome Powell, the Fed chair himself, as it's probably, likely, possibly his last meeting as Fed chair. So I've got a sort of a double-barreled question there for you here. What are you expecting on the Chairman Powell front, and then from the meeting itself?
So in terms of the meeting itself, there are no expectations in the market that the Fed will cut rates. That is a difference from when we started the year. There were still some expectations that the Fed would cut from its current short-term rate of 3 5/8 down towards 3%. And that's sort of been part of the narrative, with the incoming Fed chair, presumably of Kevin Warsh, and the strategy about, privatizing the Fed's balance sheet and bringing the benefits of monetary policy closer to Main Street rather than to Wall Street. So that was part of a whole narrative, and part of that would be to cut short rates a little bit further. Now, of course, we had the Iran conflict. Oil prices, went to $120. They're at $100 today. Inflation has picked up, as you would imagine, and even without that, core inflation, so excluding the more volatile components, has been pretty sticky. It's around 3%. And the Fed's target, of course, is at 2%. And even though 3% is a lot better than it was a few years ago when inflation spiked to 9% in 2022, remember that the CPI index, so not the rate of change, but the index, since 2020, when COVID hit, is up about 30%. So, a slowing rate of change is sort of cold comfort to a lot of Americans who are trying to put food on the table and put gas in their car. So I think that once conditions allow, the Fed will try to moderate rates a little bit more, but the economy itself seems to be okay without that. And then in terms of your other question with Jerome Powell, of course, his term as Fed chair will end, and no one is expecting anything else. And now that opposition has been removed against holding up the nomination process of Kevin Warsh, I think generally the expectation is that this will be Powell's last meeting as chair, and then Kevin Warsh will step in, and we'll see how he tries to reshape the Fed. So really the only question, I think, for Jerome Powell is whether he stays on the FOMC as a governor rather than as the chair, because even though his term as chair runs out, his term on the Fed does not. And so we'll see what he decides. There could be some political implications because as the administration tries to put more people on the Fed. If you can almost think of it as the Supreme Court, you can only put a new person on if there's a vacancy. And so whether Powell creates that vacancy by really stepping away from the Fed in total or just as chairman will be something that I think will be closely watched.
Denise, I want to bring you into the conversation now to build on what Jurrien was talking about in terms of market volatility there. I think suffice it to say, the end of April isn't what anybody would have predicted it looks like based on the end of March. So a lot has happened in just the past 3 or 4 weeks. But using your historical lens, I'm curious if you feel like any sense of surprise that stocks went from essentially near correction territory to setting new highs so rapidly.
Well, on the data, I mean, the interesting part is as we entered this year, part of the research that I did kind of suggested that equities broadly were a lot more fearful than credit markets were. And that tends to be a situation that's a little quanty, but credit markets are usually the smarter market, where when equities, that's really been the definition of this cycle, is that unlike most other cycles, there's a really quick knee-jerk reaction when bad news comes to either spike the volatility index like the VIX, or get these very wide valuation spreads when investors sell anything they think is risky and they buy anything they think is safe and they bid up these valuation gaps. That expression of fear makes it more likely that whatever it is that you're afraid of might already be discounted in the market. And you add on that, unfortunately, we have a whole lot of historical examples about geopolitical conflicts. And when you look at it over the long term, you can sort of see things from, if you take a handful of instances from Pearl Harbor to the Russia-Ukraine invasion, and you say, okay, if I bought stocks the day the conflict happened, woke up a year later, didn't look through the volatility, what were my average returns? And you'll see there's variability, but the average returns are about 8%. You see a hit rate of about 70%. And the irony behind that hit rate is that's pretty much exactly in line with historical averages, which I think tells you that, look, as much as there's variability, we don't know how this will end up. If you just look at the average, it tends to be not market moving, which means either it's not as big of an impact to earnings growth as you might expect, or the market already discounted it, or there's other tailwinds that you're not looking at that offset the headwinds.
I think most, if not all, of the volatility that you're describing there most recently can be traced back to oil and the conflict in the Middle East. So I want to get your sense of the energy sector in general, but oil in specific. I mean, we saw prices spike by at the most 70% earlier this year. But as you've explained it, the composition of the larger energy sector right now might make a spike like that, I don't want to use the word tolerable, but maybe perhaps more muted than investors might otherwise have thought.
Yeah, back to those sort of knee-jerk reactions. Anytime there's an oil price spike, you always think about the 70s and 80s, where, on the previous chart that people showed, like the 1973 oil embargo was the down area of the market because geopolitical conflict might not always be a key driver, but oil is that transmission mechanism, right? So the oil price spikes are never good in that they're always attacks to the consumer. You always see a reduction in real income growth. The question is that reduction potentially recessionary? Now, I don't know where oil prices will go, but I understand why when you look at real oil prices throughout time, we're approaching similar peaks, potentially approaching similar peaks that we saw in 2008 and in 1980. But the interesting part is it's not the same economy that those prices are hitting. So oil intensity back in 1975 and 1980 was about 2.5 to 3 times higher than it is now and rising, which means that you needed more barrels of oil to produce the same amount of GDP. So not only is oil intensity in the U.S. economy down 75% from those levels, but it's actually falling and falling precipitously. So the price impact is sort of missing the point. That might be correlation rather than causation of those oil price spikes as a translation to economic pain, because the economy that they are hitting is very different. So if you sort of redenominate oil and say, well, if price isn't the issue, maybe I should think about impact specifically as it relates to the equity market. What's the rebasement or normalization to oil prices relative to corporate profits? And what was that equivalent oil price in terms of strain in the 70s and 80s? And you'll find out the equivalent would be $500 to $1,000 a barrel. which is not to say that I think that that's what it takes to get to a recession, but it is to say that that level of strain would only be produced by meaningfully higher prices. So you might end up in a situation in which higher oil prices are uncomfortable. There might be more offsets than we're thinking about, and they might be more absorbable than you think.
Really, really fascinating context there. Thank you for that. Jurriën, I want to bring you back in to start the shift of the conversation to potential opportunities for the rest of the year. So you both, and Denise in particular, have laid out the current situation, the geopolitical tensions and volatility that are on everyone's minds. Juxtapose that, Jurriën, though, to, the frankly rosy, robust corporate earnings that we keep hearing about. I'm curious how you square those two together and what you think that might mean going forward for the next 6 months or so.
Yeah, it's a great question. Just to backtrack just a little bit, we've had this conflict in Iran. It's still ongoing, although the shooting has stopped. But the market, the S&P 500 only declined 9.8% from its high to its low, and has very quickly come back to new all-time highs. And a person might wonder, oh my God, how can that just be such a small reaction to what are pretty scary headlines? And this is where we point to earnings as sort of the hero of the story, because earnings are not only growing or holding up despite this uncertainty, they're actually accelerating higher. And we're in the middle of Q1 earnings season right now. And, about 80% of stocks or companies are beating estimates by about 10 percentage points. And if you just think about the math side, which I know Denise likes and we all like, is that the PE ratio for the S&P 500 really is the best measure of risk appetites, right? Because price is really just at the intersection of earnings and valuation. Price is what you pay, valuation is what you get. So what investors are willing to pay for each dollar of earnings is really the true measure of sentiment, if you will. And so because earnings are growing at almost 20%, and the price, is in between those two, we have to look what the PE did during this conflict and how that compares. And the PE ratio fell 19% from high to low, which is exactly what it did during the first Gulf War in 1990 when Iraq invaded Kuwait. That was a very short-lived doubling of oil prices, and it came back down. The stock market briefly went down, again, 19% in terms of the PE, and then it went right back up. So maybe looking at it in terms of valuation and earnings, we get a better sense of how sharp the drawdown actually was, and very much in line with a year ago when we had the tariff tantrum. And so thanks to earnings, the drawdown in the S&P or in the markets, the correction was only half of what it might otherwise have been. And that obviously is a good story. And again, as earnings estimates come in, and we're in earnings season right now, they continue to accelerate higher. And it's not just a U.S. story. It is a global story as well, which we can talk about later.
Yeah, absolutely. Thanks. So Denise, let's talk about some potential sector opportunities that I nodded to at the top of the show. And we'll start with the tech space, defined, it feels like these days, by artificial intelligence, which has had a bit of a rocky year, although it certainly feels like, today's news notwithstanding, that AI, there's a bit of a confidence shift coming back to it, maybe some momentum behind it at the moment. What's your sense of how you evaluate tech writ large today?
Yeah, from a valuation perspective, we're a far cry from that bubble talk that we had in the beginning of the year. So we have the data going back to the 60s, and you can look at how tech stocks are priced. Jurriën's point about valuation sort of determines sentiment. And you can divide it up in terms of quartiles. And we went from the flirting with the top quartile of relative valuation, so the aggregate tech stock versus the market, all the way down to the bottom tercile, so 33rd percentile. We haven't been there in over a decade. So from a quantitative perspective, I think that skews your odds when you look at the data. The cheaper technology stocks have been, especially relative to the broader the market, the higher your odds of outperformance. Now, 70% odds based on this tercile that we're in is certainly not 100%. But the interesting part about that 70% is those odds are similar and strong regardless if operating margins or profitability contracts, regardless of earnings growth contracting or free cash flow contracting. So a lot of what investors are afraid of in technology for all of what we're talking about might be priced in. right? So it can't tell you exactly, but if you're willing to sort of extend your time horizon over a year, again, the risk reward looks really favorable. Now, it's different this time because a lot of that valuation compression was driven by software, which is concerned over the AI headlines in terms of what companies might be insolvent, what companies might be around. Do we need companies like that anymore? So from a data perspective, I won't talk about a fundamental perspective. The interesting part for me is that software as an industry, when we have the data going back to the 60s, has never been more profitable, meaning they are in the 100th percentile of their operating profitability going back to the 60s. But on this sphere, are only in the 14th percentile of their relative valuation. So the market clearly discounted the fact that an event is coming that's problematic for software industries. The interesting part, that only happens in all the industry groups going back to the 60s about 2 or 3% of the time, and most of it happens in economic recessions. In fact, the most populated area of that was during the financial crisis. So in some ways, you could say that software is priced for its own financial crisis, if it were. So if we look at all that data and say, well, once you're there, once you have that massive valuation gap, is it enough? Do you, on average, now have an outperformance odds? And what you see in the data is it's around 50-50. Technology sectors, it's never been software, but it's been semiconductors and communication services and even hardware before that showed up, have a little bit of a higher hit rate than 50-50, but about 60%. But for me, what the interesting data show is that on average, there's no more underperformance. That doesn't mean on an idiosyncratic basis they can underperform, but it does mean that statistically, I would say your downside's limited. So if your downside's limited in software, that's a third of the technology index, and a lot of the other tech stocks got dragged down in terms of valuation compression, the risk reward for the whole sector looks interesting. And that's really been global leadership, certainly in the US, which sets up the market pretty well to have your leadership sector reprice and now have a positive risk reward to potentially drive the market higher.
Let's make the connection, Denise, if we can, from the AI build out to other sectors of the economy. There's a ton of spillover that we're seeing. Think about construction, think about machinery spending, power demand. I mean, that list goes on, all attributable to artificial intelligence and its growth. Do you see that potentially, that backdrop maybe signifying the recovery for the industrial sector?
You're starting to see it change. And I mean, it's been a long malaise. Maybe you wouldn't call it a recession, but certainly a long malaise in the industrial economy. I think that we had, for the better part of 3 years, a contractionary ISM or a diffusion index of how many manufacturers are in expansion mode versus in contraction mode. And that's fairly rare. I mean, it's been worse in the 80s, but the duration of that malaise has been very, very unique. You're starting to see a situation where a lot of the indicators, we've had some false starts over the last 3 years in the past, do suggest that we're finally seeing an inflection in the manufacturing economy. Specifically, when you look at that ISM data of new orders, you'll see that new order inflection, the bigger the inflection in new orders, and that's the chart that you see, the more likely that ISM diffusion index is to stay in expansionary territory. Now, that would be a difference. That would be a difference relative to what we've seen over the last 3 years. And to your point, if we end up in the sort of backdrop of we're above 50 in this index, which means expansionary from an industrial production perspective, and rising, that's been good for the industrial sector. And I think that the industrial sector overall is very, very diversified. But what you see is the more specific capital goods components of that sector, like machinery, like transportation, do tend to outperform when you're in that mode. So that might be something to look forward to in the latter half of this year.
Excellent. All right. So potential for growth in both tech and industrials. Jurriaan, what's your sense of the rest of the market, frankly? I mean, are we seeing that broadening that so many people want to see away from just the mega cap growth to include mid cap, small cap value?
So, at the beginning of the year, we had a very nice bullish broadening where the rest of the market, other than the Mag 7, let's put it that way, really came into its own because there was a rotation. The Mag 7 peaked last October, didn't really go down, but it didn't go up either. And that allowed the rest of the market to catch up without the index itself going down. Because remember, we're in a very top-heavy market with the top 10 stocks being 40% of the index. And if those top 10 stocks go up a lot, the index goes up. And if they go down a lot, the index goes down. And so that was a very nice moment. And then the Mag 7 started to fall when the Iran conflict started to happen. And the S&P fell close to 10%. The Mag 7 were down 17. The S&P equal weighted index, which is a good measure of the average stock, was down 7%. Now everything has come back. But what I would point out, as I mentioned earlier, is that international markets are really still very interesting, and emerging markets right now are really hot. So if you think about the year-over-year change in earnings estimates in the U.S., is 23%, which of course is very strong. Ex-US, the rest of the world, is plus 25%. So even better. And emerging market estimates are up, I think, more than 40%. Part of that is AI, semiconductors, et cetera. I think part of that is also the kind of the weaponization of commodities, if you will, in this fragmented world, which is probably a whole other show. But so there are plenty of places to go if you want to mitigate some of that concentration risk in the market.
Excellent. Denise, I want to grab your third potential opportunity, which I think might catch some people by surprise, particularly if they have their eyes on the 30-year mortgage rates. You feel like the housing sector might be ready for a bit of a rebound?
Well, it seems interesting in the sense that when you're worried about recession or economic contraction, you sort of want to gravitate towards sectors that have already potentially priced that in. And housing is sort of ground zero. You've seen a contraction in residential investment. You've seen new home sales be at all-time lows. Housing turnover is at all-time lows, lower than the financial crisis. And the interesting part about that is when you look at that data, that's usually the time that skews your odds of outperformance higher, which tells you as an investor that by that point, a lot of the bad news might already be priced in. And I would say we're seeing a confirming signal from relative price to book for home builder stocks. So when you're in the bottom decile, you see increased odds of outperformance. It's fairly linear. 65% is not 100%, but that 65% is sticky regardless of if interest rates go up, if unemployment goes up. So a lot is priced into housing stocks, and I do see that as a potential opportunity.
Housing, industrials, and tech as potential opportunities for the remainder of 2026. But I have to ask you, Denise, what's on the flip side of that coin? What would you suggest caution towards?
Yeah, so I'll take the other side in terms of from a commodity perspective. I'll say energy stocks. So for me, again, when valuation is predictive, and it's not always predictive, those are the most interesting signals I find in the market, and something that has a linear relationship. And the interesting part about energy stocks is on the pop in oil prices, they traded above a market multiple for pretty much the first time ever where earnings growth wasn't contracted. And you can see historically, the bigger your relative valuation, the lower your upside relative to the market, even if oil prices go up. So much so that since the 90s, right, this excludes the 70s and 80s, since the 90s, even if oil prices go higher from whatever point you're at when you're a market multiple, the stocks have on average underperformed. We saw this in 1993, where for the most part, I think oil prices almost doubled, and the stock spent the vast majority of the time underperforming anyway. So be careful in terms of what is already priced into the positive side on energy stocks.
I think I said it before, I'll say it again. I love that historical context, so thank you for sharing that. Before we go, Urian, definitely want to make time for Timur's take to find out what's got your attention as we wrap up April and move into May.
Obviously, earnings season, what the big tech companies are reporting. And then I'm watching what everybody else on the planet is watching, and that is how many vessels are sailing through the Strait of Hormuz, because that will determine oil prices, inflation, the economy, and basically everything else right now.
Absolutely. Denise, Urian, thank you for your time. I always enjoy filling in on Market Sense, but never more than when I get to spend time with the both of you. Thank you so much for being with us today.
Yeah, great to be back.
Thank you.
And for folks watching, thank you, of course, for taking time out of your day as well. Before we leave you, we always do like to give you a resource or two. And for today, we'd like to give you an opportunity to reflect on really everything that Denise talked about in terms of sectors. You can check out the website that's on your screen right now, fidelity.com/sector search, all one word, fidelity.com/sector search. We're also really excited to share another feature on the Fidelity's Market Sense page, where Fidelity leaders answer the questions that you all submit when you register to attend Market Sense. You can head to fidelity.com/marketsense, click on the tile that you see there to check out the responses to customer questions, viewer questions that we get every week. And you'll also find there links for more educational resources as well. Plenty of things to ideally keep you busy over the next week until Heather is back to host again next Tuesday, 2 p.m. Eastern. So until then, have a great week, and we hope to see you very soon.